get as much out of this presentation as possible. We are going to cover a lot of information really at a pretty quick clip. So just be aware of that. Maybe grab yourself a beverage of choice, whatever that might be for you at this hour. I know we have schools and parents joining from all across the country, different time zones. So whatever works for you. And then had a paper and a pen. Did I mention that? You're going to want to try to take some notes. That'll be helpful. As far as your questions go, we will try to take a few questions toward the end. We'll see how our timing works out. If you have a question that we're unable to answer during the session, don't fret. We will explain how you'll be able to get a complimentary, individualized, private college funding evaluation wherein you'll be able to get your individual questions answered. And we'll also try to get back to you via email if we can't answer live during the session. Okay. Oops. Also, folks, I'm going to put into the chat some really important information for you. We will explain what it's for and how to use it over the course of the next hour. But in the meantime, just know that it's there and make sure you access that information before you leave the workshop tonight. Hang on, I got to fix something. I'm going to close my video. So we are delighted that we have the Spring Education Group schools here with us this evening. I want to introduce Tim Pratt, who will say a few words and then we will get underway.
Thanks, Cindy, and welcome to all of you parents. I'm Tim Pratt, and I am the Director of College Advisory for the Spring Education Group, which is a network of schools that you may or may not know that all of your schools are a part of the Spring Education Group. And I have the great fortune of working with the college counselors at all of the schools. And we have one here tonight, Shay Oncom from the Basis Independent in Bellevue, Washington. And we also, there are a lot of schools, as many of you know well, that are on vacation right now. So a lot of those counselors are taking the week off. But we do have parents from all of the Basis Independent schools, from Laurel Springs School, from Stratford Prep Blackford and Stratford Prep Milpitas, from Sagemont Prep, and grateful to all of you for coming to year 2 of our partnership with SmartTrack. And I know Shay's going to say a couple of words to her parents, but I also just want to put a plug in while I have you for another webinar 2 weeks from tonight that I'm going to be hosting on STEM education within the context of the liberal arts. Really excited about that. We'll have enrollment and admissions leaders from Dartmouth College, Pomona College, and Davidson College at that event. And again, it's going to be 2 weeks from tonight. Be on the lookout for more info that should be coming in the coming days about that. But Shay, I'll turn it over to you, and you can say a few words to your parents.
Sure. Thanks, Tim. Hi, everyone. I'm Miss Oncom, and to all of my families, hello. I'm glad you could be here, but also to all families, really appreciate your taking the time out to come to this session. I know that your college counselors are a great resource, but we college counselors also rely on our resources, and we're really lucky to be partnering with SmartTrack in terms of the financial aid aspect. And I think you're in for a treat tonight with some really important information. I will not stay on for the entire session, but I just did want to say hi and thank you again for taking time out to be here tonight.
Thanks so much. Tim and Shay, thank you guys so much for making the time to be here this evening. We're going to get underway here. Just give me one sec. And Sam and Scott, you here and good to go? Let's turn on our cameras, make sure everybody's good.
Yep, good to go.
Excellent.
Everyone.
Okay, well, Welcome to everyone for this important workshop, What Every Parent Needs to Know Now About Paying Less for College. I'm Cindy Menegaz, the National Program Director at SmartTrack College Funding. But I came to the company as a parent well over a decade ago when our twins were in high school, and it really was game changing for us. So I'm so pleased now to be here as one of your hosts this evening. And I'm very pleased that we'll be joined by SmartTrack's co-founders, Sam McHale and Scott Greenemeyer. So Scott has spent his entire career in finance, including more than 2 decades as an expert in college funding planning. Scott is also a certified college funding specialist, master trainer, an investment advisor, and a former CPA. And he's our trusted CFO. Scott's real expertise is that he understands that nexus between taxes and assets and college. Sam McHale leads the team as SmartTrack CEO. He is an association of certified college funding specialists, master trainer also, with over 25 years experience in audit and tax and higher education planning. He's a sought after national expert. He's our family's personal hero. And Sam, would you tell us what got you into this space in the first place? It's kind of a niche.
Hi, folks. So I grew up in Los Angeles most of my life, and we were considered middle income, middle class, whatever you want to call it. I had decent grades, and I had aspirations to get into USC, my favorite school. And in high school, my dad suffered a major illness and became disabled and couldn't work. So we couldn't afford to send me there. And so I had to settle for schools that were closer to home where I commuted. And so that took a while. While that was happening, my younger brother started getting into high school, and I didn't want what happened to me to happen to him. So we went out there and looked for someone that could help. And back in the 1990s, there weren't a lot of people doing what we do. There still isn't that many that do exactly what we do. But we were able to find somebody with a little bit of planning, with a little adjustments and moving things around. My brother ended up attending a private college and didn't pay a single penny for his education. Now, that changed everything for me because I saw firsthand how a little bit of planning and direction can make a huge difference. And there's even more at stake now with costs of education going up, expenses going through the roof. Small adjustments that we make today for everybody, whether your income is high or low, can make a huge difference in someone's life, in their career, or how much less they have later retirement. So that's why we do what we do.
Thank you, Sam. So our nationwide team of licensed financial and certified college funding experts help families save more efficiently and pay less for college. We've been doing this for more than 25 years and have helped well over 400,000 families. Of course, we do offer some super affordable advanced planning services, but this workshop is informational. We are not here to sell you anything. There is such a tremendous amount to know about college funding that we really can't cover all of it in just this one session. So we have drafted a workshop companion guide to go into more detail on so many subjects. You are going to want to check that out. We're going to email that to you, so look out for that. Now, there are typically three different types of attendees at our sessions. One is the do-it-yourselfer. We welcome you to learn the ins and outs of the college financial process. You are going to get valuable tips today on how to improve your outcome and save yourselves time and money. I admit to being a bit of a do-it-yourselfer myself. And then we have folks who think that there's little or nothing that can be done to improve how much they'll end up paying for college, and they hope for the best. They're really resigned to paying full price. So this workshop may change your mind, and we welcome you too. Thank you for joining us. And then we have parents who feel a little confused and possibly overwhelmed by the whole process. Now, maybe they have a lot of burning questions, or they're just not sure what questions to ask. So this is so common. It's really normal. It's okay. We want all of you to get the most out of this workshop. So no matter where you start, success in the college funding process has 2 steps.
So step one is learn all you can by participating in this workshop. Good news is you're already in step one. So you need to get educated and informed about the college funding process and how it really applies to you. And since there's so much misinformation out there, we're going to try to help you make sense of it all. So tonight's about understanding that college funding planning is not just about the financial aid system or filling out a bunch of forms, but rather how to make it easier and less expensive to pay for college. And that applies to every family, regardless of your income and assets. So what you see on the screen here are the main goals of this college funding workshop. We'll cover how the college and the government assess your financials, explore various funding options, and why timing is so important. Scott's going to go over that. And I know it's a lot, but hang tight. There's about 4, 5, 6 hours of information crammed in about 55 minutes. So get as much as you can, write as much notes. The second step is to find out which of this information actually applies to you and how it applies to you. So your school's making this evaluation available to you at no cost, absolutely no obligation. So you'll get a personal, confidential college funding assessment by a college funding expert with at least 10 years of experience in their field, not like a call center person, an actual expert in the field. So if you have questions or you're not sure, this is the time to ask it. You'll get specific tips, recommendations on your specific family situation. So we'll show you how to access that in a little bit. And after getting your assessment, if you feel like this is something you should tackle yourself, great. If you need someone to help, you can work with us or anybody else you feel comfortable with.
So do you remember what college cost when we were young? We could afford to take a small loan or work at a pizzeria or get a little help from mom or dad. But now take a look at these examples of current US colleges' cost of attendance, or COA for short, for 1 year of college. Now, whether your child attends a public or private institution, in state or out of state, the full cost of attendance for a 4-year degree, that includes tuition and everything else, room and board, books, fees, transportation, etc., will run you between about $100,000 to as much as $400,000. And that's per child. That's a really distressing reality for a lot of parents.
So, as Cindy explained, colleges are very expensive today. Now, the good news is there are ways to reduce those costs. So, let's take a look at some of the different types of grants, scholarships, and aid that's available. So, the first would be need-based aid, and this is awarded based on parents and students' income, assets, and other factors. Now, there's a lot some parents can do to improve their eligibility in this area, and this is something that will be covered in that personal evaluation that Sam discussed. Then we have merit aid. Now, this is going to be available at most colleges. The biggest exception is those top tier Ivy and Ivy equivalents. They just don't need to provide merit aid to attract top students, so they base everything on need. But most other colleges are using merit aid as a tool to entice students that are at the top of the academic profile for their school. Now, merit aid is primarily based on the student's record or resume. However, it can also be impacted by parents' financials, how those financials are organized. And again, there's more about this in the workshop companion guide. Then we've got athletic scholarships. Now, full ride scholarships are rare here. Most typically, we're going to be looking at partial scholarships. The exception would be, certain big money Division I sports, those top tier football, basketball programs. And also keep in mind, Division III cannot give any athletic scholarships at all. However, having a coach that really wants your student on their team can enhance both the admissions and other scholarship possibilities for that student. And this is why academics are very important, even for student athletes. And then the last one would be private scholarships. Now, these are, scholarships. They don't come directly from the college. It's, Fortune 500 companies, employer groups, nonprofits. they tend to get a lot of publicity, but actually make up less than about 4% of the total scholarship funds available each year. They can also be very time consuming to pursue and provide no guaranteed results. Now, depending on the colleges applied to and specific things in your situation, there can be a lot of different financial aid applications and forms. You'll need to know what each college requires, when they want it submitted, and how each is going to assess your income and assets. But let's take a quick look at the two most common forms, the FAFSA and the CSS profile. So the FAFSA is a federal government form that is used by colleges' financial aid offices to award aid from federal government, state government, if applicable. Not all states have programs, but some do, as well as institutional money. And that's money that's coming directly from that college's budget. Now, there are many details regarding the FAFSA included in the workshop companion guide. We just don't have time to cover it all here. But one thing that's really important for you to know right now is how the timing of the information on the FAFSA works. So for income, it's going to use what's called a prior tax year. So for a student graduating in 2027, they would be looking at the income from 2025 calendar year, which is when your child's still in the 10th grade. However, and this is really important for our senior families, the assessment of your assets is based on what you have on the day you filed the FAFSA, which is typically in the fall of the senior year of high school. So due to this, some strategies involving income work best if implemented before that prior year. However, there are other strategies involving assets work right up until the time you file the FAFSA. So the takeaway is start planning early if possible, but know that you have not missed all opportunities if your student is already a junior or a senior. So then we've got the CSS profile, and this is a much more in-depth financial aid application required in addition to the FAFSA by some of the private colleges. Not all, but some of the private colleges. Now, depending on the schools your kids are applying to, there can literally be hundreds of questions on this form. It's no fun to fill out for sure. They're going to ask, questions about your income, assets, retirement accounts, home equity, and a lot more. And some of the information is used directly in the formulas and some is more discretionary. But one thing to keep in mind is you want to be conservative with any valuations you provide. So, if they ask about the value of your primary home or rental properties, make sure you're not inflating those numbers to what you wish it was worth. Be conservative, give yourself a little bit of discount. And keep in mind, the timing in this form works exactly the same as the timing on the FAFSA form. And, colleges are going to use this forms only for that institutional aid, money that's coming directly from the school. Because of the length and the complexity, there can be a lot of errors on these forms. And there is a lot of money at stake for some families. So you want to make sure you do everything possible to get it right.
Now, parents, your child really should drive their college application process, of course, right? But don't leave something as important as the financial piece to your 17-year-old. You really have to manage this part. You're going to want to find out all of the required forms for each school and their specific deadlines. They may differ from admissions deadlines. And don't rely on what you see in a Google search. You're going to want to check each school to verify. I find that keeping a spreadsheet is really, really helpful here for you. You're going to want to give them exactly what they're asking for and nothing more. Plan early. Be accurate. The majority of applications, as Scott mentioned, they're filled with errors. So make sure you read the directions and rules really carefully and submit on time. You're also going to want to check the portals for each school regularly to make sure your file is complete. Now, if you need help, we offer a premium software suite for our high school families. It's at a reduced rate of $247. It can help you take yourself through that process step by step. Our goal, of course, is to save you money in many different ways. It's not just aid. So there are definitely companies that will charge you thousands of dollars to do these forms for you, but the vast majority of you can do them on your own or with a little support. So either way, just getting your financial house in order before you ever submit these forms, that is the best tip we can possibly give you. So, Scott, will you talk to us about how colleges determine whether a family gets scholarships, grants, or financial aid?
Yeah, sure. So the starting point is going to be the FAFSA and the CSS profile form that we just discussed. The information on the FAFSA will generate what's called a Student Aid Index, or SAI, and the CSS profile will generate the Expected Family Contribution, or EFC. We'll use the acronyms for the rest of the workshop just for time's sake. So that SAI or EFC reflect how much the colleges think you can afford to pay out of pocket per student each year. Now, many parents can be shocked by how high that SAI or EFC comes in at, but keep in mind there are many things that can inflate that in addition to just your earned income, investments, businesses, different types of passive incomes, which means there also are many ways to lower that SAI or EFC with proper planning. So the formula is cost of attendance for the college minus the EFC or SAI equals your need, how much need-based aid you qualify for. So since the EFC and SAI are used to determine your financial need, they can make a huge difference in what you'll actually pay for college. So obviously, the lower the SAI or EFC, the greater your need. And some families will already have a low SAI, EFC, and many families have the ability to lower that with some planning.
So like Scott said, the lower your SAI or EFC, the better, but also the more generous the college you're applying to, the better. And the best case scenario is to show as much legitimate need and apply to at least some schools that are historically generous with aid. So there's so much misinformation out there that I want to stress that every college in America wants you to think that they're the most generous college that has ever existed. But this cannot be further from the truth. Some colleges will not cover much or even any at all of your need, while others will cover that need in the form of loans. And then some generous colleges will cover the vast majority of that need in the form of gift aid, which is what we want. So when researching colleges, don't just rely on their self-reported claims, their endowment size, or net price calculators. You want to really know statistically how generous they've been for parents with your specific SAI EFC. This can make a huge difference in how much you pay at the same college or even at a more prestigious school, one that maybe seems to be more expensive, much more expensive, maybe out of reach, could end up costing you the same or even less than a public school.
So we get thousands of questions from parents each year. So here we're going to take a minute just to answer a few of the most common ones. So this first one here, how do I find out the college I'm applying to is generous or not? So as a part of their participation in federal student financial aid programs, colleges are required to provide aid statistics to the federal government. This is primarily done through various surveys submitted to what's called iPads, NCES, or even the Department of Education. Now you could research these records and trend results over the past few years, or keep in mind we put a lot of effort into purchasing, doing our own analysis, updating those numbers. And in our premium software tool that Cindy mentioned called Smart Navigator, we rank every college by green, yellow, or red based on these historical statistics. Now, another question we get is, what if I'm divorced, separated, widowed, never married, remarried, or both biological parents have remarried? This can be more complicated since the rules on, whose information is going to come into play can vary a lot depending on which school you're applying to, which financial aid forms they use, and it can, and sometimes even create strategies. So this is definitely something you'd want to bring up in that personal evaluation and make sure you have a good understanding of what the rules are based on your specific situation.
So we get questions about applying early decision versus early action and whether those things are going to affect your cost. So an early decision application is a binding offer to the college. You can only apply early decision to one college, and then if accepted, you're supposed to pull your applications from the other colleges. As a result, we do sometimes see lower financial aid offers because they just aren't as incentivized to be competitive. They know that's where you want to go. Now, early action is not binding, and you can apply early action to multiple schools, so it has a lesser impact on financial aid. And then, will applying for financial aid reduce our child's chance of admission? I find this to be kind of thorny. So some schools are need blind, so applying for aid will not impact the chances of acceptance. Other schools are need aware, and applying for aid could impact the admissions decisions. Now, you have to balance between your ability to pay full price out of pocket and your desire to get into that school for your child. It doesn't do you any good, though, if your kid gets accepted and then you can't afford to pay for it. So think about that.
So what about 529 college savings vehicles? These are vehicles that people save over a decade or more for college. And people ask us all the time about them, but it's important to understand that every college assesses 529s as part of your overall assets when calculating your eligibility using your SAI and EFC. Some schools will even go back and reduce your aid package each year by 25% of your 529. So they'll take your 529, split it into 4 parts for each year, and sometimes go dollar for dollar as a secondary reduction. What about the changes in the Department of Education? Well, at this point, not much has changed. So plan on submitting. Either way, whether there's a FAFSA in the future or not, there's going to be some type of form where you're going to fill out financials so they can determine who to give this money to. So be prepared. In a few minutes, we'll address some new college loan limits that Scott's going to talk about that you need to be aware of. And we're also going to go through and break down 4 sets of clients in just a moment.
Okay, so let's take a little closer look into families' financials. Keep in mind, every family situation unique. Every family has different levels of income, types of income, assets, different school lists for their kids, different academic level of their students. So therefore, there's no single strategy that works for every family. However, in general terms, families will tend to fall into one of the above 4 quadrants. You can see we've got modest or lower income and assets, or the opposite of that, high income, high assets. Now, when we're talking about assets here, we're not including your home or your retirement accounts. But then we have families with higher income but lower assets, and then some families that have modest income but have significant assets. There's a whole bunch of different scenarios that can happen. So each one of these quadrants will have different challenges or opportunities associated with each. So we're going to take a look at an example from each one of these. So let's start with that modest income, low asset. That income could be, who knows, 75, 100, 150, maybe even up to 250,000 in some situation, but lower assets. Now, this is the most straightforward scenario. Advanced planning is not quite as critical for these families since they're already going to be eligible for need-based aid. However, there are some real significant things they still need to be aware of. So maybe your financials are similar to Sarah's here. You can see she's, a nurse. She's just got one child to put through college, graduated in 2024. Again, modest income, 72,000. Non-retirement assets, pretty in college savings are fairly an asset home equity. So let's take a look at what the scenario is for now. One of the most important things for these families is completing all the financial aid forms on time and accurately, and also applying to generous schools. Now you can see here on the slide the schools that we had. Well, this is some of the sample awards from her school list. And the schools we had identified red and yellow, the awards were quite poor, but we predicted that. But the green awards were really, really good. And Sarah's daughter ended up attending this last one, Green College B, with over $64,000 in aid. Ended up saving over $250,000 and had a net cost lower than the cost of a public school that she also applied to. Now, one of the big takeaways is, we see families in the same situation not getting these kind of results. And usually it comes down to one of two issues. Either one, not applying to generous schools, or two, making mistakes in the financial aid process, missing requirements, missing deadlines, reporting inaccurate information. And the biggest one is that generosity level of the college. That generosity level is way more important than the sticker price in determining the actual net cost for a family. A generous $80,000 school can easily produce a lower net cost than a $50,000 school that is not generous.
Say you're a family on the opposite end of the spectrum with higher incomes and significant assets. These are families that maybe have $300,000, $500,000, $800,000 of income. And often they think there's nothing that can be done to help them. Most parents don't realize that there are lots of ways to save on college costs, even if they don't qualify for need-based aid. So let's take an example. There's numerous ones, but just grab one here. Again, you don't have to be the exact same situation here, but the example still applies. So maybe you're like a parent like Anna and Peter. Their income is well over $600,000 a year with their bonuses, and their non-retirement assets are, more substantial. So there maybe won't be any kind of need-based aid, but whether your income is high or low, whether you go to school that costs $35,000 or $100,000 a year, you still have to have a way to pay for it, right? So we focused on merit awards, and examinations were made on how and when to use their savings and college fund to pay for college. And we also used one of several tuition recovery plans. We'll talk more about that in a minute, which allowed the family to keep some of that money that we're going to spend on college a little longer and kind of recoup a little bit more growth on that money over time. So you can see Anna and Peter picked up over $100,000 in merit awards. And then also, in addition to that, captured $125,000 so far in their tuition recovery plan, or TRP. Since we're on the subject of TRP, let's talk about that. So we mentioned a couple times, one of the most unaware college expenses is lost opportunity cost, meaning once you write a check for $35,000 or $100,000 a year, that money's gone forever, right? You're never going to see any of that money again. And so TRPs, or tuition recovery plans, are popular ways parents can grow their college funds longer, but without that college assessment penalty. And it can reduce risks and lessen their opportunity cost loss. And, there's lots of different ways we can do that, but it can help load balance those 529s or other asset types that you're going to use anyways, and provide more growth potential recovery, right, out of those funds. And you can use that for college in the future. There's, like I said, different ways to do it. Sometimes we even use a couple ways in conjunction with each other. So the right plan is different for every family, but if this is something you want to look at, just write that down in your notes, circle that, and bring it up in your evaluation. We'd be more than happy to go over it with you.
All right, so moving on, we also talked to many families with high income, but fewer assets. Here we see families with incomes could be 4 or 5, 600,000 or more, but for whatever reason, they just have not been able to save enough for college. Now, families who fall in this quadrant also frequently think they won't qualify for any aid. There's nothing I can do, and they just lose hope. But similar to our last group, that's often not the case. So here we've got an example, and we've got Mark and Lisa, and you can see Mark is a business owner. So if you own a business or are even self-employed, pay really special attention to this example. Now, if you look at the rest of the profile, you see that the income, the business is generating a good income over 400,000, but they're, non-retirement assets and college savings certainly are not enough to pay for two kids' college educations because they have twins that graduated in 2024. So being a business owner creates tax strategies that are just not available for W-2 employees. These strategies allow the business owner to pay for a portion of the college bill with tax-deductible dollars and to qualify for federal education credits that W-2 employees with the same income will not be able to qualify for. So that was an important part of it, but we also needed to focus on cash flow strategies, way to create more cash flow to fund the gaps, and also looking at a TRP strategy like Sam just talked about. So if you look at the results, you'll see that Mark and Lisa, the two kids, by the time they're done, they'll receive 88,000 in merit scholarships between the two of them, plus $9,000 in just tax savings, and a $40,000 in tuition recovery so far. So over $220,000 saved and counting. And particularly as you look at those tax savings, 94,000. That's just savings in how you pay for college. It's not free money from the college, just savings that are available in how you paid for college. And you may be wondering if that's really achievable, but it's not out of the ordinary. We see this all the time with the families that we're working with.
So if you're a family with low or modest income, but significant assets, and when I mean low income or modest income, 100, 150, 200,000, even up to 250,000 in some cases, and with significant assets, you may have the most potential to benefit from advanced college funding planning. So there's a lot of confusion out there from parents, from their financial folks or tax people, thinking that just because they have a lower income, that automatically means a lot of aid. In these cases, though, it's not how much money you have, but where those assets are and how and when you use them that makes the biggest difference. So obviously, generous schools and properly filling out forms are really crucial here. So this one's really interesting. Edwin's semi-retired, Kim's a part-time realtor. Edwin's pension, Kim's real estate job, they have moderate income, but they've done a great job of saving over the years and also recently inherited additional funds. And we're talking non-retirement money. So you can see here, non-retirement is substantial, but it doesn't have to be that big. It can be a fraction of that, makes a huge difference for some folks. And these funds will certainly have caused them to lose out on scholarships, grants, and aid. So it's really critical to look at repositioning options to legally and ethically help them be assessed as favorably as possible within the DOE rules. The goal here was to balance their need to pay for college, but try to preserve as much of that for retirement so that it wasn't lost to college expenses. So let's see what happened with Edwin and Kim's situation. Edwin and Kim's kids picked up about $53,000 a year on average of gift aid. So that's two kids, 8 years. And both kids, so that's a significant amount of money. Plus, they also recovered $70,000 in their TRP account. Okay, and so over the next 8 years, that's $500,000. And that TRP savings, that's regardless if you don't get financial aid grants, merit money, or other kinds of awards.
Okay, so let's change gears here and talk about the ways families can pay for college. Now, a lot of parents say they're going to pay for college from their cash flow, meaning their monthly income. Scott, can you talk a bit about that, please?
Yeah, I mean, paying some of the college bill from income or cash flow is typically a part of every college funding plan, and there can be a lot of hidden cash flow if you know where to look for it. But the one thing to keep in mind about cash flow is it's usually contingent upon your job or your health. So, therefore paying for college is with that money is absolutely, not completely guaranteed.
Now, we hear from parents that they've been told by a college rep or read on the college website that there's like a hard and fast income cutoff for getting aid. Is that true?
Well, remember, there are multiple ways to get free money from colleges, as we discussed. I mean, if we're talking about academic scholarships, athletic scholarships, there are no hard cutoffs. Based aid, there certainly is a point where the family income will be too high to qualify. However, since there are other factors involved other than just earned income, things like assets, number of family members, age of the family members, how many are in college at the same time, the cutoff point is not going to be the same for every family. And given the high cost of college today, that cutoff point is often higher than many families think. And keep in mind, there could be things that are artificially inflating that income that can be fixed, or the income that fluctuates from year to year, or have an unusual one-time income hit in certain years. And there are strategies to help with all of these issues. Now, we also see, the other side of the fence with, families with lower income who assume they'll automatically receive aid because of the low income. But Sam's got an example he's going to show us that, shows that that's not always the case.
Yes, we had a family last year that went and visited a bunch of schools. All of them were like top 50 schools, and they made it part of their plan to talk to the financial aid office at every school. And they brought up their fact about their income, and they make between $130,000 and $145,000 a year, depending on the year. And so every one of those colleges said, "Oh, based on that, you certainly will get a ton of money." And so Yale was one of those schools. And as you can see here, this is directly from the Yale website. If your income is between 100 and 150, the average scholarship was $63,000. Well, what happened with this family? Well, they ended up only getting $19,000. So what went wrong? Well, they had saved some money in 529s and they had some non-retirement assets. Nothing crazy, just, good savers. And so the schools did not award them that much. Now, if you look at the next page, this is directly from the Yale website. It says Yale calculates the EFC calculation through a holistic review process, and those errors point to parent assets and student assets. So, it's important not to assume that just because your income or assets are too low or too high or whatever, you won't get aid or you will get a ton of aid. That you want to make sure that you're diligent, that you read the fine print and always properly prepare ahead of time so you don't end up being surprised later.
So as you've probably already figured out by now, your income does play a major part in that SAI EFC calculation. And how the assessment on the income works is there's a table similar to like a tax table where your lower dollars of income get assessed at a lower percentage. But as you move up through that table, the top bracket is 47%. So once you've hit that top bracket, which many, many families will, every additional dollar of income raises that SAI or EFC by 47 cents. And, when people think about income, they tend to gravitate towards just their earned income. But we built this chart just to show that there's so many other types of income that may end up being assessed by the colleges. And depending on the type of college, it can fall under one of these three formulas. But the big takeaway here is that, part of that college funding planning process is to manage the impact of these other types of income that you can control on your tax return. And frankly, most families, or even financial professionals for that matter, just don't understand how all this works.
Thanks, Scott. So let's move on to using assets to pay for college. So a lot of families will consider using their checking, savings, CDs, or money market investment accounts, stocks, real estate. I've even had clients ask me to use, maybe should we use our retirement accounts to pay for college? But without proper planning, liquidating assets may cause a taxable event, penalties from the government. It can reduce your principal, and that money isn't growing anymore. That opportunity cost loss we talked about. It can hike up your EFC SAI. I see that almost every day where that happens. For example, let's say you have an account that being in that account may or may not even count against you, but now you've taken it out, made things worse. So it's out of its shelter. And now the asset counts, and maybe it has other things happening onto your tax return. And Scott's going to go over that today. By the way, a couple things. So you can see like this is much more complicated than originally in the beginning of this workshop. We're giving you as much information as possible. And so Scott's going to break down how assets and income kind of work against each other when it comes to college.
So when it comes to assets, not all assets are treated the same. So depending on the asset type and the methodology used by the college, you could be assessed anywhere between 5% of the value of that asset each year, or up to 25%, or even more. And just so you know, student assets are assessed at a much higher rate than parent assets. That 25% assessment is associated with student assets. So, we've seen clients that had maybe, $100,000, but it's in the wrong place, and that's going to cause them to lose $10,000 to $25,000 or more of free money each year from the college. And based on our research, the average parent we see can reduce that EFC SAI calculation by around $24,000 a year just by making some adjustments. Now, the other thing that can happen with assets is some of them can have what we call a compounding impact. And what we mean by that is you have this asset that's being assessed against you, so that's bad enough. But then on top of that, that asset is generating income. I mean, it could be rental income if it's a rental property, or it could be interest income, dividend income, capital gain income. But you're generating income that's also being assessed in addition to the assessment on the assets. And that income part can be very damaging, because we just talked about for many, many families, that assessment on that income is going to be 47%. Now, the third way in the paying for college would be loans. And loans can be a big part of many families' college funding plan. In some cases, it's required to fill a gap because they just don't have the resources to cover the bill without some type of financing. But in other cases, it could be a choice to do some financing because they don't want to deplete an asset, because they want to avoid the tax consequences or opportunity costs associated with that asset, or maybe it's to utilize a TRP strategy. Now, when it comes to the loans, there's a lot of deep workshop companion guide. We don't have time to cover it all here, but I do want to point out a few things. First of all, as Sam mentioned, there have been some recent changes to the federal loan programs. The biggest change for undergraduate is that federal parent direct loan. You can see it's now limited to $65,000 total over a 4-year undergrad for each student. It's actually $20,000 a year up to a total of $65,000 over 4 years. There used to be no limit on that loan other than what the college costs were. So this is a new limitation. Now for graduate programs, there's some severe limitations, dramatic reductions in federal eligibility on the graduate side. Now, a couple other things to keep a mind of is that you don't have to finance college with traditional college loans. And traditional college loans could be, the federal student and parent loan, or what are called private student loans. College, you want to look at what all your options are, where the best rates and terms are. Don't think it has to be financed using traditional college loans. And, since the interest paid on those loans, becomes part of the overall cost of college, having an effective borrowing strategy can have a dramatic impact on the overall cost of college. So, and again, when we're talking about, evaluating loan terms, a low interest rate, that's great, but it's not the only thing to keep in mind. You got to look at what the required payments are, because a low interest rate isn't helpful if you're not going to have the cash flow to keep up with the payments, which we see happening sometimes for families with multiple students to put through college. So, kind of the overall takeaway is, make sure you're looking at all options that are available to you. Assess whether some financing makes sense, even if you don't need to use it to preserve assets or utilize a TRP strategy. And, the goal is to come to the lowest overall net costs. And, these loans can be expensive sometimes. And Sam's going to show us an example of what we mean by that.
Yeah, thanks, Scott. So let's take a look here at a family income of $250,000. They have some non-retirement assets. They have some 529s. Maddie and Luke are a couple years apart. They're both college bound. And Maddie's dream school is a $90,000 school. Certainly their school's less expensive and even more expensive. So they applied, and let's say they got some scholarships, grants, and aid totaling $6,000. So their net cost is $84,000. Still a chunk of money, right? But with a little bit of planning, we looked at their income. We looked at seeing if there's any passive incomes we can clean up, some of those assets that are going to hurt them, making sure that those assets are not going to count against them. We're able to kind of maybe pick up an extra $25,000 here. So it went from $6,000 to $31,000. That's $59,000 instead of 84. 59. I get it. 59 is still a lot of money. But that's $25,000 per year, or $100,000 per kid, or $200,000 total. Let's say you could only afford that $59,000, but you couldn't afford the rest of it. You needed to take loans. And if you took that $25,000 a year for those 8 college years of loans, if you factored in the interest, the fees, and the term of 10 years, and we did it in the minimum amount of time, that $200,000 over that time would be closer to $322,000 to $408,000, depending on the interest rate. And we used a range of lower and higher interest rates. So it's really important to make sure that you're maximizing how you pay for college and making sure you're paying the least amount for school, because whether it's $84,000 a year or 59 or 33, it's still a lot of money, and there needs to be a game plan to pay for it in the most efficient manner. The other thing that I would like to suggest to you guys whenever you're doing planning is that, based on our experience with our clients, 78% of our parents will go through at least one life-changing event during the college process. It could be marital change or loss of a partner. It could be a loss of a job for a significant period of time, or inheritance, retirement, sudden financial change, market losses. So if the plan that you have in place is based on if everything goes right, then please reconsider that, because 3/4 of our families will go through a situation during this process that will throw a monkey wrench in everything. So whatever plan you decide to do, factor in what if something goes wrong and how will you recover. So before we go any further, we are gonna, yeah, go ahead. I'm sorry.
So to wrap up our conversation about ways to pay for college, note that private scholarships from employers or membership groups or corporations, as Scott mentioned, they get a lot of attention, but they are typically smaller amount. They don't renew yearly often. They can reduce your need-based aid packages. So just be sure to manage your expectations here, parents. And then it's not for everyone, but using a transfer option is a strategy for some families to reduce their overall college costs. Here, the student attends community college to complete the general education requirements and then transfers to the college or university of their choice as an upperclassman.
Okay, so before we go any further, we're going to try to take a few questions if we have the time. So just hang in there. But as we wrap up step one, which is attending the workshop, gathering as much information, I hope you were able to gather a lot. I know it came at you like a fire hose, but we wanted to really make this valuable for you guys. So the next step is how this applies to you. Which strategies should you apply? What's the best option? Is it qualifying for more grant scholarships and aid? Is it improving merit athletic based awards, maximizing asset recovery that can save you, 10, 20, 40, 60, $100,000 in those TRP accounts? Is it capturing the tax savings like Scott was talking about, which is very common, something we can do? And most CPAs that you work with will be like, yeah, that's something we can do. Yeah, why not? Is it using low or strategically low interest rate loans, some of which are going to be an effective rate sub 5%, sometimes even sub 3% in some cases? Is it growing and protecting what you already have saved so that you have it later in retirement? So that's something I want you guys to think about tonight.
So as we get toward the end of the session, I want to go into more detail about the second step of your college funding education, which is your personal college funding evaluation. Now, your school has arranged for you to get this valuable benefit with tips and recommendations based on your specific circumstances and needs. Now, the process is entirely private. SmartTrack never shares your information with your school or the government or any third parties. There is no cost to you. There is no obligation whatsoever. You will get an honest, objective analysis of your positioning. Our advisors are all licensed professionals with extensive training and years of experience. As Sam mentioned before, you're not reaching a call center. You're really talking to our professional advisors. Now, if your financials are relatively straightforward, we will point you in the right self-directed to the right self-directed resources to implement strategies on your own. And if advanced planning can make a consequential difference for you, then we'll let you know that too. Now, you can choose to work with us or someone else or do it yourself, whatever makes the most sense for you. If you do decide to work with us, our comprehensive services are surprisingly affordable. So because we extend our steep discounts through your high school. So in all, we're talking about less than you'd probably spend on 1 or 2 college textbooks. So just be aware that there are options out there for you should you want to look into them, okay? All right, so to get your SmartTrack evaluation and access, we also have freemium resource tools on our platform. You'll have to create an account using your school's custom link and the email address you use to register for this workshop. I put that information in the chat. If you don't see it, no worries. I'm going to add it in there again. And also look out for our follow-up email. We'll include it there too. Now, just make sure you use your school's custom SmartTrack link. Don't just go to our public-facing website or you will not get the special benefits involved. Our system accommodates 1 parent account per household. Please don't try to create student accounts or multiple parent accounts in the same household. If you already have your account set up, great. You can log in anytime at app.smarttrackcollegefunding.com. It's all in the chat. Now, creating your account, though, is not enough to get your evaluation. You have to complete a 5-minute assessment. So that's really the only way that we're going to be able to give you feedback that's specific to your situation. So let us know some basic information about you. Only takes a few minutes. Now, we do not ask for any personally identifiable information, no dates of birth, no social security numbers, no account numbers, no tax returns, etc. The assessment is also secured by military grade security protocols, so your information is safe and it's private.
And when you're answering those assessment questions, you don't have to pull your tax return and all your statements so you can give us exact numbers. Your best approximation, is completely fine. What's actually more important is just making sure you're giving us a comprehensive picture. So make sure you had all the family members in your household, count all your assets and all your real estate. For your income, if you get commissions and bonuses in addition to your base salary, include your total income, not just the base salary. The more comprehensive the picture, the better we can assess and the more meaningful that evaluation will be.
And look, we love doing this and we love answering questions, whether you work with us or not. So this is something that's offered to you. I know that a lot came at you at this workshop. That's fine. You're going to have your unique situation. We're here to help. So get your evaluation, sit down, have your questions ready. We'll do our best to answer it. And then you can decide how you want to do it after the call or not.
Okay, so I want to quickly recap your next steps so you know exactly what to do after this workshop. You're going to create your SmartTrack account using your school's custom link. You're going to complete the quick and secure assessment questions and then follow the on-screen prompts to get your evaluation. So look out for an email from us tomorrow with a recording of tonight's presentation. We want to thank you so much for joining. Thank you to your counselors for setting this program up. That is all for this workshop. We hope that you found it helpful and learned so much. We really look forward to being of service to you. So Sam and Scott, are you okay to answer a few questions? I see that we have here in the Q&A.
Yeah, if we have a couple minutes. So I jotted a few questions down. See how many we can answer. Hey, my son's a junior. Is this too early to start? So in our office, freshmen and sophomores even are the best time to start because it's before your base year. So like Scott was saying, if you have a 2027, for example, then 2025 is your base year. So everything that happens in 2025 gets held against you. So if you have a 2028 or 29, perfect. That means you can do things without having it influence your base year. If you have a junior, we call you 911 in our office. So you have a 911 family. That's because your base year is about to expire. We have like what, few months, few weeks, whatever left at the end of the year, right? So we want to make sure that you're able to kind of get those things done. And like Scott was saying earlier, if you're I mean, I don't know what you call senior if the juniors are 911, but if you have a senior, I mean, you're weeks away from submitting those forms. So you want to do some last minute planning. And remember, you're going to be submitting forms every year. So we want to make sure you put your best foot forward. So if you're a senior, my humble suggestion is try to get an appointment as early as possible so that you're not waiting too long because it is getting to be the end of the year as we get busy in the busy season.
All right, so I see a question here. I'm divorced, who should create the account, who should attend the assessment? So keep in mind, as Cindy said, the account needs to be created by whoever's email was used to register for this workshop. Now, during that assessment, like we talked about, there's some complicated rules. And so we may determine that the other parent also needs to create an account. But, if you're divorced and you belong and you want to have a joint meeting together, that's perfectly fine. We've seen that happen successfully. If it's not possible for you to work together in that capacity, we can do a separate meeting with the other spouse if needed. And just a quick sidebar, students are not required at the meeting. These are really financial meetings, not admissions meetings. So you don't, I mean, they're welcome if you want to have them attend, but they're certainly not required. And so again, if you're divorced and you can work together, we can have the meeting, a joint meeting. If not, we can do them separately. Obviously, if you're married, we're assuming you can work together. So we'd love to have both parents at the assessment. Now, if you're married and you don't get along, I mean, I guess we can have another webinar next week to try to help out with that situation.
I had a client ask me, like, when is that next week's workshop? So I have actually two real quick. So 529, should we still contribute to 529s? we're not going to give you that kind of financial advice without knowing what's going on. But I will tell you, generally speaking, parents that we talk to in that 8th, 9th, 10th, 11th, 12th grade, most of them have already stopped contributing or maybe slowed down their contributions. Some still contribute. Most of them are age-based 529s, which means as you get closer to middle school and high school, they kind of level off as far as taking risks. So they usually, not always, but they don't perform as well as they used to when they were younger, where they're a little bit more aggressive. And that's not a bad thing necessarily. The chances of you losing a ton of money is also diminished. So there are other options that you can consider that can load balance those 520s that have less restrictions and less assessments that we could certainly talk about. So if you have that question, whoever asked that question, certainly bring that up in your meeting.
I had seen one before too. Now, we really try in these workshops not to make this a sales pitch. We don't want to talk to you about the advanced services that we offer, but the question always comes up. So we'll go ahead and talk about it. And that is, if we can help you and you opt to work with us, we have two pieces. There's the premium suite of self-directed software that by itself is $247 all in. There's three really important components of it: school generosity, merit aid, and helping you through the process of doing your financial aid forms and applications and make sure that you get that process right. So that's the software piece. Then there's the advisory piece where you would meet with an advisor to develop and implement your best college funding plan. If that's something that makes sense for you, by itself, it's $397. That's the discounted rate through our high school initiative. Together, we offer the two pieces in a bundle for $497. That's a one-time fee, not per student, not per year. And you compare that to, comparisons without the open market, and it's, can cost you many thousands of dollars for the same kind of service. So we really try to offer an affordable alternative, but please don't rush out to purchase this because you may not need it. We tell people all the time, you don't need this type of advanced service planning because it's not applicable to you. So have your evaluation. You're going to learn a whole lot, get some great tips and recommendations. If college funding planning is going to help you, your advisor will tell you that, and then you have all kinds of options, whatever you want to do, if anything. So just clarity and transparency, that's what we offer. Hope that's helpful. Please look for an email from us tomorrow. It will have a link to the recording so you can review this, share it with your partner or spouse. It will also have the link to set up your account through your school if you aren't able to pick it up into the chat or from the chat right now. And it will have the workshop companion guide. So all of that. I do see a question that once you pick up the software, you'll be able to use that ongoing. Our bundle package is really designed to help the family through the entirety of the college process with all of the kids in your family. I saw that question. Anything else, Sam and Scott? We're a little late. We're a little
I got a
running
ton
late.
of questions, but I don't think we have the time. So look forward to talking to you when you're ready, but try to get on as soon as you can while things are fresh in your mind.
Scott, Sam, thank you guys.
Thank you.